A home equity line of credit, HELOC, is a revolving credit line secured by the equity in your home. It can be a flexible way to access funds for renovations, debt consolidation, or major expenses, but it's not without risks. Unlike a traditional loan, a HELOC functions more like a credit card, with borrowing limits based on your available home equity. Before applying, it's essential to weigh the benefits and potential pitfalls. In this article, we'll explore the top 10 things to consider before getting a HELOC to help you make an informed financial decision. 1. Your home is the collateral. With a HELOC, your home serves as collateral. This means if you fail to repay the borrowed amount, you risk foreclosure. While this makes HELOCs easier to qualify for and typically lower in interest than unsecured loans, it also places your home at risk. Always consider your ability to repay in full, especially during the repayment phase when monthly payments may increase. 2. Variable interest rates can rise. Most HELOCs come with variable interest rates, which means your payments can fluctuate based on market conditions. While introductory rates may be low, they can increase significantly over time, making budgeting difficult. Before committing, review the lender's terms regarding rate caps, adjustment periods, and how interest is calculated. 3. Draw period versus repayment period. HELOCs typically have two phases. The draw period, where you can borrow and make interest-only payments, usually lasting 5 to 10 years, and the repayment period, where you must repay the principal and interest. The switch from interest-only to full repayment can cause a steep rise in monthly payments, so prepare financially for that transition. 4. Your home's value may change. The amount you can borrow through a HELOC is based on your home's current market value minus your remaining mortgage. If home values drop, your equity could shrink, potentially reducing your credit line or causing your HELOC to be frozen. This can be especially problematic if you plan to use the funds later or during an economic downturn. 5. Closing costs and fees. Although HELOCs typically have lower upfront costs than traditional mortgages, they still involve fees. These may include appraisal fees, annual fees, inactivity fees, or early termination charges. Be sure to ask your lender for a full fee schedule to compare offers and avoid surprise expenses that eat into your credit line. 6. Impact on credit score. Opening a HELOC will result in a hard credit inquiry, and your credit utilization can affect your credit score. If you borrow a large portion of your available credit, it may increase your debt-to-income ratio and reduce your creditworthiness. On the other hand, responsible use of a HELOC may improve your score over time by adding to your credit mix. 7. Tax deductibility rules have changed. You may have heard that HELOC interest is tax deductible, but under the current tax laws, as of 2024, this only applies if the funds are used for home improvements on the property securing the loan. If you use the money for debt consolidation, vacations, or other purposes, the interest is generally not deductible. Consult a tax advisor to understand the implications for your situation. 8. Long-term financial goals. Before tapping into your home equity, consider how it aligns with your long-term financial goals. Will it add value to your home? Help you avoid high-interest debt? Or will it extend your debt burden? A HELOC can be a smart move when used strategically, but it can also delay your ability to build wealth if misused. 9. Alternatives may be better. Depending on your needs, a personal loan, cash-out refinance, or 0% APR credit card, for short-term financing, may be better options. These alternatives might not require you to risk your home or could offer better fixed-rate terms. Always compare interest rates, repayment flexibility, and overall costs before settling on a HELOC. 10. Lender terms and flexibility. Not all HELOCs are created equal. Review different lenders' terms, including minimum withdrawal amounts, repayment flexibility, interest rate structure, and customer service reputation. Some lenders offer fixed-rate conversion options or interest-only payment extensions. The more flexible and transparent the lender, the better suited they'll be for your financial needs. A home equity line of credit can be a powerful financial tool when used wisely, but it comes with serious obligations and potential risks. From variable interest rates to the risk of losing your home, a HELOC should never be taken lightly. By considering your financial stability, future plans, and available alternatives, you can determine if a HELOC is the right move. Before signing anything, shop around, ask questions, and consult with a financial advisor to ensure your decision supports your broader financial goals and protects your most valuable asset, your home.